Welcome to the Capital Property Fund's portfolio update for July 2026. My name is Joe Christie. I'm the Executive Director at Capital Property Funds, and I'm joined by two of our portfolio managers, Noah Morabito and Xander Ryan. I'll hand over to Xander to introduce us to the July 2026 portfolio update.
Thank you, Joe. I'll just start with a quick snapshot of the credit fund. So it currently has 30 active loans. We just paid our most recent quarterly distribution for the June 30 quarter, and the credit fund continued to meet that 10% per annum return, so ahead of its 9% target. And the fund over the quarter had quite a large inflow of funds, so it basically doubled from 10 million to 20 million. So we're very pleased with that growth, and we expect that to continue as kind of our investors shift away from individually picking loans and just kind of getting that broad exposure and kind of the benefits of the credit fund. I'll just quickly do a bit of an insider and in-depth analysis of the credit fund. So these are the average holdings over the June 30 quarter. So as you can see, there was an average 5% cash holding, and then we had quite large exposure to townhouses, land, childcare, commercial. So a large broad exposure, and you're getting a little bit of everything. So we really like that diversification factor, and I'll let Joe and Noah speak about that shortly. But the credit fund, it's targeting 9 for the last 2 quarters. It's beat that return. We're targeting an LVR of 67.5 as a weighted LVR. For the quarter just gone, it was just over 64%. So underneath that LVR target, which is very pleasing. And we've got 2 redemption windows, the 15th of March and 15th of September, and you've got to give 45 days notice for that. So the next one of September is coming up. So if you were looking to make a withdrawal, get your notice in. I'll just hand over to Joe and Noah to talk about some of the highlights of the credit fund.
Yeah, thank you, Xander. Yeah, so as you can see on this slide, some of the highlights of the credit fund is that unlike the debt fund, investors in the real estate credit fund are always invested. So you don't have to worry about redemption periods or funds ending in time. If you want to take units out, as Xander said, just feel free to let us know. And there's 2 redemption windows in the middle of September and March. So with the debt fund, that works with like a loan might go over and you might be held in for an extra 2 to 3 months. But with the credit fund, you always have that certainty knowing that you have cash available and it's always liquid. And further to that, you have diversification across the full loan book. So 30 loans at the moment, and that's set to increase as we look to get more loans on the book. And then, Joe, do you want to speak more to the compounding effect here?
Yeah, thank you, Noah. I will, before I jump onto compounding, is the other thing which seems to be proving popular with investors is the set and forget. So you're getting one taxation statement, one holding statement, one distribution statement, as opposed to having 5 or 6 different holdings. So that's proving popular. And the other thing too is there's an option within the credit fund for investors to choose to reinvest their earnings from the fund. And you can see here in the graph that if you had started with $100,000 holding in the fund, by about year 7, assuming that distributions continue around about that 10% mark, by the end of year 7, your holdings will have grown from 100,000 to 200,000. And that means 2 things. A, you've doubled your capital holding, but also your income will have doubled as well. So when you started out with a $100,000 holding paying $10,000 a year, by year 7, you'd have approximately a $200,000 holding paying approximately $20,000 a year. So if you wanted that option, you can choose it. So as Xander mentioned, it's proven to be quite popular since we've focused on this credit fund, and it's nearly doubled its holdings in the last quarter.
And just a quick note on that graph there, that's not taking into consideration taxes. It also considers that you reinvest your distribution. So there's a few things to consider there, but it really does show the power of that compounding effect. We'll just highlight a couple loans that the credit fund's in and some of our debt investors are in, and then we'll wrap up the update. So I'll just start off with Brookwater. So Brookwater, we've got a Class A paying 10.5% and a Class B paying 18%. For investors that were looking to get exposure to that Class B 18%, you have the option of it either going in the Class A for a 2-to-1 ratio or you can do a 2-to-1 ratio with the credit fund. So you can, instead of doing directly into Brookwater, you can get that broad exposure as your Class A in the credit fund with the 30 loans, and then that higher yield exposure to Brookwater. So something to consider, and this will be for all the Class A going forward, not just Brookwater. So you can do that Class A as the credit fund instead of the individual loan. But anyway, I'll hand over to Noah just to give a little summary of how Brookwater is going and what's going to be happening in the future.
Yeah, thank you, Xander. So I was up on site with CPF's development management team just last week, and they've had really positive progress on site. I'm not sure if investors have seen some of the photos, but it's a really undulating and difficult site. But good news is that they're fully out of the ground now, and from here it'll be more of a simple build moving forward. So it's just like once they get that first floor slab down, they can just go on with their normal blocks and building from there. And then, yeah, so we've got an April 2027 practical completion date when investors can expect those returns. But expect something shortly about further communications about the delay. But it's all on track now, and we're happy with the progress they've had on site. As I said, it was just the initial planning and approval delays, and they also had some rain on site with the difficulties there. But we're really happy with this loan and looking to see it complete early next year.
Yeah, investors will be receiving something this month in July about if they wanted to roll over for the extension till that April 2027, or if they were looking to redeem those funds and place them elsewhere. I'll pass on to Joe for Openvale, but we've got a Class A paying 10.75 and that Class B paying 19%. I'll hand over to you now, Joe.
Thank you, Xander. Yes, Openvale is a land loan, and we're calling it a dormant residential land lot, really. So it will present 379 residential land lots within the Singleton region or the Hunter region, and that'll be released over 9 stages. We're going up on site, the team, in July to record a video where we'll meet with the project sponsor and just talk about some of the benefits of this particular opportunity. But look, what I like about it is those land lots are what I call will service that entry-level market. So you'll be able to get a house and land. So he'll be selling land for around about $350,000 a lot. You can get a house on that for, say, $400,000 or $500,000. So it's that affordable end of the marketplace. It's close proximity to schools, retail, employment opportunities, and also into Newcastle. So if you haven't had a look at Openvale, I would encourage people to do so. You can access that through the Real Estate Credit Fund, and then you can also access the Class B units, which are paying 19%. Or if you want to just get pure exposure to it, you can access it via the Class A units paying 10.75. So that's Openvale for you.
Thank you for that, Joe. I'll now pass over to Noah to talk about Toowoomba. Thank you.
Thanks, Xander. Yeah, so Toowoomba's been it's been one of our it's been on our loan book for a while now, but good news is that they're expecting practical completion just within the next week or two. So I will be up on site just to, final checks and certifications. But after that practical completion date, there'll be about 1 to 2 months of titling. And then from there, investors can expect to receive their repayments from the loan. So it'll be about 2 to 3 months from today's date. I'm recording this on the 9th. But yeah, just that titling process. It's all just a formality now. And then we'll look to get investors back their initial capital. But still expect, the distributions just went out last week, still paying that 11%.
11.
Yeah. But yeah, all going well, and final 3 month stretch now.
And just as a reminder to all those invested, they're all land lots have been sold to the one builder, so they'll be sold as soon as titling is ready. So a very straightforward exit strategy for this loan. Moving over to Riverview, so this is we've got a Class A paying 10.25% and a Class B paying 17%. We settled the loan at the end of May, and since their DA was submitted, they've received their approval. So they've got their DA now, and they shortly will receive their BA. So a great story there. We expect them to be starting construction on site at the end of July. And they're building industrial units, 21 industrial units, and they're building them for a price point around about $500,000, which is quite an attractive price point, we feel, and should we think should move the stock quite quickly. So we're looking forward to Riverview getting started in construction and moving forward. So a great little update and a great success to the sponsors there, getting all their approvals and moving on to construction. I'll finally just touch on Toowoomba. So we've got a first mortgage at Class A paying 11%. For those who don't know, this one has been with us similarly to Toowoomba. They had a little bit of a rain delay last year, and that's just kind of pushed, and they've had a bit of rain this year as well, which is just keeps kind of pushing out their schedule. But practical completion is expected at the start of September. And then it'll be that planned sealing process that we expect to take, approximately 30 days, 35 days, and then a repayment in October. So it's quite unique where the sponsor, there's actually a group of shareholders there, and they've all got, 2 to 3 townhouses each. So we think some will sell them and some will just straight refinance them out and repay the loan. So, we're looking forward to getting Toowoomba done. They've done a great job on site. They're getting quite high offers on some of the townhouses, and the valuations seem to be quite strong. So we're looking forward to them, signing those contracts and getting some sales away. So a great update at Toowoomba, and it'll be sad to see this one go. Well, thank you so much for, unless Joe or Noah, you had anything else?
No, look, the only thing I would comment on that we're probably seeing more lending opportunities than we have in the past. So I think funding into the marketplace has tightened up a little bit. So there's more lending opportunities certainly than we've seen over the last few years. And unfortunately, we're not able to fund them all. From just a high-level market perspective, I think that means that there'll be less supply of stock coming into the marketplace. So I think that bodes well for our back-end refinance. It means that there'll be less stock, but still seems to be a large market of buyers still around, particularly for residential and industrial. So pricing seems to be good. We've got a good supply of lending opportunities and less competition in the marketplace. So I think the market is quite good for us at the moment.
And I think further to that point, Joe, is for our investors, what we will see is better quality loans coming to us. Not to say that we've done lesser quality loans, but now we have the ability to be a bit more picky with what we're doing and stuff like that. So we're seeing high quality assets coming to us, and we'll be investing in the best loans.
And pricing terms too. I think, we're not getting we're more of a price maker than a price taker at the moment. So I know that there's been issues with war in Iran, a little bit of inflation and an unfriendly budget, which has probably been a negative. But on the positive side, financiers like ourselves that are still doing construction funding, it means there's been a lot more lending opportunities because a lot of our competitors seem to have pulled out of the market. So we're cautiously optimistic about the next quarter, to be honest, Xander.
Yeah. And I just have to think that all the loans that new loans coming our way, they're 10.75, 11, 10.5. So we expect strong returns to continue, and hopefully for the credit fund we can break above that 10% per annum return. We can get 10 low tens hopefully. So that's what we're aiming for, and hopefully we can deliver that to the investors in the credit fund.
Absolutely. Yeah.
Amazing. Well, thank you so much for coming to the July 2026 portfolio update, and we look forward to seeing you in August.
Thank you very much, Xander.
Thank you, Xander.
See you, Joe. See you, Noel.